Welcome to Loaners, your channel for all things student loans. I'm Tosh.
And I'm Demi.
Be sure to subscribe so that way you can see our uploads. All right, so what are we going to talk about today, Demi?
So after kind of going through and having our video about the public service loan forgiveness waiver, we decided to talk a little bit more about consolidating your loans and refinancing your loans and what that really means and how they are different.
Yeah, so first things first, let's define consolidation. I want you to know that in plain language, what we're trying to talk about is when you bundle all of your student loans together to make up one new loan. This means that you're going to have a new principal and a new interest. And this can actually be done for your private and your federal loans. And what I want you to know is that you can consolidate your federal loans into a private loan, which I do want you to know also that that is a whole nother conversation that Demi and I will have with you all very shortly. All right.
So for the basics now, we're just going to talk about what consolidating means and what most servicers require for a consolidating or refinance. At a bare minimum, you must not be enrolled in school, or you have to be at least below part-time status. You have to be making your loan payments, or you can still be within your grace period, but you cannot actively be in a place where you're getting loans. So you can't be in school still getting loans. You have to have a good repayment history. And so that means if you're defaulting on your loans, you may not be able to qualify for consolidation. And lastly, you have to carry a certain amount. So this can be at least $5,000 to $7,500 on your loans. Now, this will change depending on the state and the servicer. So states like California, there is a minimum amount if you want to refinance. So these are all things to keep in mind as we go through this video and kind of just like whip out all this information for y'all. So another thing that's really important to distinct between consolidating and refinancing is that you can't consolidate private loans. You can only consolidate federal loans. You can, however, refinance your federal loans into private loans. You can refinance your private loans into newer private loans, and you can consolidate your federal loans into different federal loans. I hope that makes sense. We're going to put a little blurb up just so you can see what equals what. So we're going to list the 5 things that you should know before consolidating. This was all over, the U.S. Department of Education's financial aid website. We'll include the links below in the description box. Feel free to check those out if you just need to read through it yourself rather than hearing us talk about it. But we really wanted you guys to know this information. And let's be honest, no one visits those websites. So first thing you need to know is your monthly payment may go down, but it may also increase how long you pay. So you essentially will have an overall higher interest, and you may be paying for a longer amount of time. And so you are going to be paying more potentially. Keep that in mind, because the whole point of doing things like consolidation is you're trying to decrease your payments, whether that is over time or in the moment. So you really have to weigh those pros and cons. If you have any unpaid interest on your loan before consolidating, that will go into your principal balance. And so once you consolidate, that means your principal balance will go up. So what that really looks like, for example, if you have $27,000 of principal balance on an unsubsidized loan with 6% interest, in scenario 1, you'll have $0 in unpaid interest at the time of your consolidation. So what that means is once you consolidate your new loan, you will pay $46,425 over 20 years on a standard repayment plan. And those monthly payments will be approximately $193. However, in scenario 2, you'll see if you have an unpaid interest, in this example, $3,890 on your loans at the time they're consolidating, that will then be capitalized, and your new principal balance on your new loan will be $30,890. So what that means is over 20 years on a standard repayment plan, you will pay $53,113. And that monthly payment will end up being $221. So although your monthly payments don't look that different between scenario 1 and scenario 2, your overall pay that you have on this loan will vary a lot just because of those $3,000 of unpaid interest that you capitalized in your consolidation process.
Those pros when it comes down to consolidating your loans, think about it. It's going to be super easy to manage all your loans because they're all going to be bundled into one monthly payment. On top of that, you might maybe see lower monthly payments, which you saw in that scenario that Demi gave us. In addition, I still want you to know that you will have access to those loan forgiveness programs. And then I know Demi said to take a look at our weighted interest example. So make sure you know how to calculate that weighted interest. One more time, it's pretty easy. I'm sure that you all can do it, all you grads out there. And then also you'll have access to COVID emergency relief, which by the way is continuing. Thank you, President Biden. And then cons that we need to talk about. I do want you to know that you will have a longer repayment period. It's basically like starting over at one point or another. Also, you will have to pay more interest overall and make more payments because one more time, we're talking about restarting your payment plans all over a 20-year period. I want you to know that if you do not have your interest paid down to 0, that will then be added into your principal because you do have to take care of that. And then there's also a loss of certain borrower benefits. So you do have to be cognizant of that, in addition to qualifying for payments towards your IDR payment forgiveness as well. And then you can lose other just benefits truly because you end up consolidating from one servicer to another. And then one really downside to this is that the moment that you consolidate, you no longer have that grace period if you are just straight out of college and you're just waiting to repay. So just be really mindful of all of these downsides to consolidating. All right. Cool. I do want, well, we should tell them though, that we want them to know one benefit that I didn't mention. Sorry, Demi. I just want to make sure that this is very clear that for folks that end up having a variable right when they ended up deciding to get their loans, that will end up being a fixed interest rate if they want to go ahead and do that. And I highly recommend you doing that at this moment, at this time. I understand that interest rates are going up, but they're still at historical lows.
Yeah, definitely. I mean, if there's any time to fix your variable rate, feel like a older generation now, this would be it. So moving into refinancing. So like we talked about earlier, you have consolidating and you have refinancing, and you can only refinance private loans. In theory, you could also consolidate private loans, but essentially private loans just kind of coined refinancing. So they have their own little part of it. It's a little different, but pretty similar. So what that means is, say you want to consolidate them, technically you would refinance them, and you can refinance a federal loan into your private loan and have those be together. And in order to do any of these options, you, unlike federal loans, would end up with a new interest rate on your private loan. And this is determined by your credit score, and it's not a weighted interest. So say, for personal example, I had 2 loans with Wells Fargo, one for my first year in college, one for my second year in college. And they were at different interest rates. They were different types of rates. One was a fixed and one was a variable. And I got them and I refinanced them and I put them together, and it was an awful, awful, awful interest rate. So thankfully I refinanced it again. But they picked a interest rate for me based on my credit score and my co-signer's credit score and how much debt I had. And that's how they did it. They didn't do it as like clean and predictable, I guess, as the federal government. Now we can make a video about what it's like to get a federal loan and refinance it to a private loan. Let us know in the comment box below if you want us to do that. It's really risky. I've known a lot of people who have done it. I personally have it. I like the benefits of having a federal loan, i.e. this COVID waiver. I had a lot of debt that was just frozen and I got to pay down a shit ton of interest or shit ton of principal because interest wasn't accruing. And that was like the only time in history we've ever seen that. Like, honestly, the US Department of Education doesn't even know how to unpause right now because they have never done this before. So that's why I personally have it. But let us know in the comment box below if you want to have a whole discussion about it. We would be happy to. Maybe we can even do a live stream and talk about it. Let us know.
So that concludes our consolidation versus our refinance video.
Let us know what else you want to hear from us, and we look forward to seeing you soon, loaners.
Bye, loaners.
Bye.